welcome to Cordant's market update for the first quarter of 2021. If you paid attention to the news and the headlines, it seems like a lot happened in the quarter. We had things like GameStop, we had cryptocurrencies in the news, we had a big, huge infrastructure stimulus package in the news, and hedge funds blowing up and banks losing money. But what we're going to focus on today is what the returns across various markets, equity markets and bond markets across the world were. Look at where we are over the last year. We've come a long ways in terms of the recovery, both in the economic recovery and market recovery. Just take a look at how far we've come over the past year. We're going to answer the question, are markets expensive, or on a relative basis, which areas of the market are more expensive or not? We're going to check in on the economic recovery. Interest rates are up in the quarter, check in there, and check in on inflation. So a lot to cover in this update. We're going to do that here in 1 second. So stay tuned. A lot happened, at least if you're paying attention to the headlines in the first quarter, but across the stock market, both US and international, things were up. Pretty good quarter, not too unusual though. Bonds are down in the quarter as interest rates were up. Best performing markets across the world were US stock market, international market up 4 versus a little over 6 in the US, emerging markets 2, and global real estate up 6 as well. As you can see here, bonds were down again as interest rates were up. Diving a little bit deeper into the various areas of the global stock market, first, US stocks. So US stocks, as a reminder, make up a little bit more than 50% of the total stock market across the globe. Thing to note here is a pretty big dispersion between different areas of the US stock market. So in general, US stock market up 6%, but as you can see, small value up 21% in the quarter, small stocks in general up about 12, so double the market in total. And then some of the worst performing areas were small growth and large growth. Now, this is basically a flip of 2020, where some of the best performing areas of the market were growth names and large cap growth names. Some of the companies that were actually had benefited from the economic situation that we found ourselves in, everybody working from home. So kind of a flip here in 2020 so far, and we'll see if that holds true throughout the rest of the year. With international stocks here make up less of the world stock market, but still a significant portion of the world stock market. Same story here. So value and small cap did better than the market in general, with growth lagging behind in the quarter. And again, similar thing in emerging markets. Small cap and value were the best performing areas of the emerging markets, and large cap and growth names less so. So that's a check-in of where we are, just kind of across the globe in various markets. Again, a good quarter and a good year over the last year. One of the things that we talked a lot about last year was what happens typically after a bear market. So typically a bear market drops about 35%. Last year we had a 34% drop. So very average bear market decline. What do the markets typically do after that? 1, 3, 5 years later. So what you can see on this chart here is typically 1 year later, returns are quite good, both for the total market or for smaller companies that tend to outperform following a bear market. And that's exactly what we saw. So on average, total market in the US at least is about 50% up after a bear market over the next year, and about 75% for small companies. So how'd we do? What was the actual experience over the last 12 months? Basically, the bear market bottom was at the end of March last year, thereabouts. And looking at through the end of March this year, over that 1 year period, how did we do? And turns out the actual experience over this last bear market and the recovery was a little bit better than average. So we had 63% increase for total market and about a 95% increase for small company stocks. So a really strong 1 year recovery after the market that we saw for first quarter last year. So obviously good to see. Everybody's happy that the markets have bounced back. Really, the one note to caution here is, we had good returns in this first quarter, obviously good returns over the last year. Everybody knows this, but this isn't the way it works every single year. So history being a guide, in 2009, a similar situation coming out of the recession, saw really strong returns in 2009, pretty good returns in 2010, but it's not like this every single year. So in the last market recovery, 2009 through 2020, we had years that market were down or low return. So what I would just note here is, yes, we've had a great last 12 months, but don't expect this every single year. The market's not going to go up every single year. And that's, part of the reason. Obviously, investing in stocks, there's some risk associated with it. But part of the reason there's a return associated with it as well. So even though not every year you're going to get, 10% or greater returns for your equity investments, still over this last period, 2009 through 2020, $1 invested in global equities turns into $3.72. And that's even with the drawdown that we had in 2020. So not every year is going to be as great as the last year that we've seen, but still equities over a longer period of time have tended to produce pretty attractive returns. Now, one of the other questions that we get when it comes to equity investing is just, now that we've had a really great 12-month period, are things expensive again? One of the things that I would encourage somebody to look at, and is certainly based on the way that we invest, where we try to have a little bit more of a tilt in stocks to some smaller company stocks or some more value stocks, is if you just look at the high level, things might seem more expensive than they are if you look under the hood. So put up a chart here. This one's from JP Morgan and their guide to the market. But if you look at just the top 10 stocks in the S&P 500, they're much more expensive than basically the rest of the market beyond that. So right now, top 10 stocks, at least as of the end of the first quarter of 2021, the top 10 stocks were trading at a little bit more than 30 times earnings. And that's a PE ratio, how expensive they are for every dollar of earnings. Top 10 stocks were trading at 30 times. The S&P 500 in general is 21 and a half. If you split out those top 10 names, really below 20, 19.6 for the remaining stocks. So that's still above kind of the historical average over the recent past, but much less expensive if you take out the weight of those top 10 names and kind of the most expensive stocks. So these are, Google, Amazon, et cetera, stocks that have done well, but tend to be expensive at this point. So that'd be one thing to consider. The other thing to consider is just different areas of the market. So Morningstar style boxes is kind of one way to do that. And they'll split things between large companies and small companies and value to growth. And what you can see on this chart is one conclusion relative to the last 20 years is that everything's a little bit more expensive, at least a little bit more to a lot more if you're talking about small growth. Things are more expensive than they have been over the last 20 years. So that's true by the numbers, but within that, different areas are more or less expensive. So what you can see is value tends to be cheaper than growth. In terms of its own history, it's always going to be cheaper than growth, but even in terms of its own history on a relative basis, cheaper than it has than some of these other areas. And then smaller stocks, smaller companies are less expensive than larger companies right now. So that's one thing that I would present just as to the question of where are things expensive or where are we seeing more opportunities. Now, as you probably know, we tend to have a bias towards more value and more smaller companies, which this sets that up pretty well. Now, there's probably some reasons, some things that we won't get into here, but some reasons for valuations being above the 20-year average. So interest rates being low, a lot of money out there, et cetera, et cetera. Okay, now the next thing that we want to talk about here is just where we are in terms of the economic recovery. We're technically in a recession still. We've had some recovery from that, but where are we? One of the things that we can look at, in addition to kind of the headline data, GDP, employment, things like that, are some more frequent, high frequency economic data. And these are things like hotel occupancy, travel, mortgage applications, et cetera. And then what you can see here on the data here, again, this one's from JP Morgan. We had a pretty big drawdown in 2020, but on a lot of these measurements, we've at least come a long ways back, or some of them actually above the levels towards the beginning of 2020. So purchase applications, mortgage purchase applications, consumer transactions are actually above the beginning of the year. last year. And then some of these other measurements, hotel occupancy, travel, et cetera, have made a pretty decent recovery on where they were. So that's one thing to be paying attention to. The other thing that I think markets are paying attention to is just how quickly economies reopen. A big piece of that is the vaccination piece of the puzzle, and how different countries are doing in that, in terms of getting their population vaccinated. So that's another thing that certainly the market's paying attention to, and that we'll continue to pay attention to as well. Last thing that we wanted to touch on in this market update is just interest rates and inflation. Now, obviously, these have been making the news lately. Interest rates were up in the quarter, and inflation making the news as well. So just where are we in terms of interest rates and inflation, and kind of what does that mean? One thing that we saw earlier was that bonds were down, and that's because primarily interest rates went up. So here we're looking at where interest rates were on US Treasuries at the end of the year versus the end of the quarter. And you can see from about 5, 7, 10-year loans, 10-year Treasury bonds, the yield has increased quite a bit here in the quarter. And typically, what's going to happen when interest rates go up, your bonds are going to go down. So that's why some of this is good news. The market is anticipating higher economic growth going forward, and so it makes sense to have a higher yield on these. There's more of a risk appetite, and people are more willing to buy equities and less bonds, which is going to drive down the price of bonds or the interest rate up. Just for a little bit of context, kind of where we are versus where we were last year and where we were back a few years ago, 2013. And what you can see kind of in the darker gray on this chart is that's the range over the past 10 years. We're kind of in the middle of this 2013 and 2020 point. And so a couple things here. So one, we've been positioned towards the shorter end of what they call the yield curve, which means as interest rates go up, we're not hurt as much. Kind of the decision to do that was as the yield curve was pretty flat, you weren't getting paid a lot to take on some of this interest rate risk. And so, why take on more interest rate risk if you're not getting paid more? Now that the yield curve is starting to steepen and rise, you'll probably see us kind of shift some of that maturity out. So take on a little bit more interest rate risk because we're getting paid a little bit more for that risk in terms of the yield curve. So that's one thing to look at there. The other thing, obviously, making headlines is inflation expectations, and they are rising. You can see that in the data here, but they are rising. Some of that is due to some of the stimulus packages that are out there, some of the money that's out there, and just the economy improving. Pressure on wages, pressure on commodities. Timber is a big one that's in the headlines right now. So inflation expectations are going up, but again, these are going to be pretty tied to interest rates. And so one of the questions we get is, okay, if we do have an inflationary environment, what are some of the best places to be? And I think one thing to keep in mind here is, even though inflation expectations are going up, this isn't an extremely high or hyperinflationary environment. Expectations over the next 5 years are a little bit more than 2%, which is essentially in line with the Fed's expectations. The other thing to keep in mind here is things could be wrong. Somebody that expects high inflation going forward, could be wrong. I remember in 2008 and 2009, there was a lot of stimulus out there then, and the expectations were this is absolutely going to cause inflation. Didn't really play out that way. So situation now is different than it was then, but our approach is always going to be a little bit humble, be a little bit cautious. Nobody knows the future perfectly, and things could be wrong. So I think there still is a case for bonds in somebody's portfolio, especially if you're pulling money out of your portfolio. Having that diversification, that stability in the portfolio actually allows you to have a much more stable and higher withdrawal rate over somebody's investing horizon. So that's one thing to consider. But definitely, if inflation is higher than expected, that's not going to be good for bonds. So what are some areas of the market that would do well under an inflationary environment? Well, kind of three things to think about there. So one, stocks have historically done okay in an inflationary environment. And that's because a lot of times companies are going to have pricing power. So they can increase the price of their products, increase their revenue in line with their expenses. So whether that's payroll, whether that's commodity inputs or other things, on the top line, the revenue line, they can then pass that on to the consumer essentially and kind of keep up. So stocks historically have done pretty decent over an inflationary period. More short-term inflationary surprises, upside surprises, actually cash is not a bad place to be. So think of cash as essentially a zero maturity bond. So it's constantly updating its yield. And when rates go up or when inflation goes up and rates go up, you cash in the bank can adjust to that immediately. Whereas compared to a 5-year bond, you've kind of locked in that interest rate. And if rates are higher in the future, you don't get compensated for that. So cash is not a bad place to be. The other place, commodities, especially in shorter term, when inflation's kicking up, a lot of times commodities will respond to that. And so you see that really across the board here in the first quarter. A lot of commodity prices were up. Gold would be the exception, but a lot of commodity prices are up. And so commodities are a decent way or a decent hedge against inflation as well. So that's it. Inflation expectations are up, but some areas of the market, some areas or things in your portfolio that actually do well in an environment like that. So that's it. That's the update for the quarter. Hopefully this is helpful. Quite a bit happened in the first quarter, and hopefully you're now up to speed. Okay, we'll see you next time. Thanks.